Good morning, everybody. Today we have Mike Alberico. He is my number one lending partner. We've been working together since I started in real estate in 2018. He runs the Alberico Mortgage Group, local mortgage broker with U-Mortgage. Morning, Mike.
Morning.
Good morning. And also joining us, we have Robert Pieklo. He is the VP of revenue at U-Mortgage. So he kind of works at the corporate headquarters, and he does all the forecasting for this mortgage broker. Rob, if you want to just tell us a little bit about yourself and your background.
Yeah, kudos to you getting my name right. That's a big one. That's a good start. So my function here at U-Mortgage is kind of oversight of margins, pricing, lending relationships, partners here, and just making sure that we have the best pricing and best program options for our loan officers and our obviously our customers. So the oversight there, my background is in capital markets, even though we don't do trading of securities and hedging yet. But in terms of what we do and what I've done in the past, traded, billion-dollar pipelines before. We've done, all the securitizations for all the main government-sponsored entities that are out there, and oversaw both the capital markets and the originations for small companies, mid-sized companies, and publicly traded companies.
Okay, so now you are, I'm thinking of you as like the de facto economist for U-Mortgage.
I would say your budget rate guru, maybe. That we'll say that. There's probably some better ones out there. But yeah, so being around this space for 20 years and being in capital markets for 15, I am the de facto, I guess, forecaster for our company and have an understanding of where things are going, both short-term and long-term.
Okay, awesome, Rob. And Mike, before we jump into our conversation around interest rates and the market, just for people who might not know, I know a lot of my clients that have worked with you and a lot of my sphere at least know you. If you would briefly just let us know about Alberico Mortgage Group and the difference between a mortgage broker and a mortgage lender. You hear those things those terms thrown around a lot, and a lot of people might not know what the difference is. So if you wouldn't mind explaining that before we jump into it.
Yeah, absolutely. So I've only been on the wholesale side since 2012 when I got into this business. I was at a smaller brokerage in Raleigh for 9.5 years and came over here. I'll be almost here 2 years in February, so a few more months till we hit that. And one of the things that attracted me to U-Mortgage is the way that we kind of build out a hybrid. So we're not a direct lender and we're not 100% broker anymore. We're what's called a non-delegated lender. So we actually fund the loans in our name, but we have 20 different lending partners that we can work with that do the underwriting. We have internal team that you and your clients work with, from processing, closing, et cetera, from start to finish. Reason the hybrid model works is it gives us a little more control over costs, as well as a little bit more competitive pricing. So it's just a little bit of control factor, but we're also not employing in-house underwriters. And most importantly, why I never left this broker model is because I want to have options. I don't want to be tied to one set of underwriting guidelines, one set of rate sheets. Like prime example, I do a lot of VA lending. Some of our VA lenders are pushing hard for VA loans. They might be priced a quarter better on rate. So we have that option and flexibility, and we're building out a team here and just excited to where the future takes me and U-Mortgage and my partners like you, Cory.
Yeah, we're rocking and rolling. So what I really want to talk about today is, we were talking before we started recording, like a lot of people, a lot of my clients and a lot of prospective clients that I talk to, like everybody wants to know the future. And I don't want to start there, with our imaginary crystal ball that we may or may not have. What I would really like to focus on is, myself, people in the real estate industry and the finance industry, and then obviously just people thinking of buying a house or selling their house. All they see are these, bombastic headlines about interest rates with very little context around, interest rates going up or down. And so, Rob, what I would really appreciate is, like, I know that these swings in interest rates that we see almost daily, or, every couple of days, there seems to be some sort of change. They don't happen in a vacuum. So would you just briefly explain sort of the different factors that go into interest rates going up or down as we see it today?
Yeah, let me break out my charts now. I think it's important to understand that this is a commodity that's traded. That's what people sometimes get confused. These things trade on a daily basis, and just like anything that's happened, you kind of understand what happened with GameStop and what happened in terms of trading and crypto and all these different things that do trade. Things have
Diamond hands.
accelerated. Yeah, exactly. Things have accelerated, and what's different kind of this time around with rates just in general is the velocity of the moves. And that's where I think on a daily basis, we're used to moves. It's when things move very fast, it gets very hard for lenders to put out rates and put out interest rates and sheets. And everybody's trying to figure out what's going to be happening over the next 3, 6, 12, 18 months when they're factoring these things in the trading world. And that just has huge impact. And with algorithms coming in and money coming in and trading these mortgage-backed securities, you can see the pricing piece of this move quite a bit, even if, like yesterday, CPI was off by 1/10.
What's the CPI?
So CPI
Consumer Price Index.
It's Consumer Price Index. It's one of the key metrics of inflationary data that the Fed looks at when they're determining short-term interest rates, because Fed is required to kind of go over short-term rates, which does have an effect or have a correlation with longer-term rates just based on what people see in the market. So, when you see the CPI number come out, it was a little under what was expected. So the actual number was just 1/10 lower than what was anticipated to come out. And we saw mortgage rates rally where you can see, maybe in the, from the morning to the afternoon, we saw about a quarter different, or day over day, a quarter to 3/8 different in interest rate of what would be offered on a standard, purchase, which is a lot in a day. That's a significant move. We saw 20 basis points, so like 0.2 difference in the 10-year treasury yield, which is a gigantic move in the markets. And we saw a lot of money flow in because that's the way it works now. We get a small little number and people are like, oh, maybe this has shifted. And a lot of money comes pouring in because nobody wants to be on the wrong side of this trade. So you see some overreaction these days, and the velocity of the moves are significant. And it does impact mortgage lenders and what rates they offer, especially for those that are on the better end of the pricing spectrum. And I say that like our company, we proudly run on very thin margins. When you have robust margins and much higher interest rates than some of our competition does, maybe they don't have to move as much because they're making more on each loan, like you see in all these stats that come out from the MBA. But for companies like us that run thin on margin, you're going to see multiple reprices during the day. You're going to see some, the velocity of the moves. You're going to see rates move quite a bit on a daily basis based on the data that's coming out.
Okay, so I want to just qualify one or two things that you said. So my understanding is that the Fed's decision, they're looking at unemployment rates, they're looking at the CPI, all of these factors go into the interest rates that the base rate that the Fed puts out.
Yeah, the overnight rate. Yep.
The overnight rate.
Yep.
But what you said in the very beginning was that another factor is this sort of secondary trading market where these mortgage-backed securities are swapping hands at an ever increasing rate. So take me through which one of those factors is having a greater impact, and tell me what's the order of operations? Like Fed comes out and says this is the overnight rate, and then all the mortgage brokers have to adjust, and all the lenders are adjusting to that every morning, every hour, every day. And then behind the scenes, the secondary mortgage market, they're also adjusting what they're going to buy and sell these loans for. Just take me through that kind of process, because I want to understand the relationship between those two factors, because they seem kind of separate, but also
together. Yeah.
Dependent on each other.
Yeah. So
does that make sense?
Yeah. So the Fed, it's often thought that the Fed's interest rate kind of changes affect mortgage rates directly, and they don't. Right. First and foremost, the Fed is in charge of, we'll just call them short-term rates. So when the Fed makes a change, you can expect changes to things that are based off of prime. So like home equity lines of credit, car loans, credit cards. You'll see it. Like you always see it on the back of your credit. I don't know if anyone looks at the back of their credit card statement. If it's they
prime plus one or whatever.
Prime plus, a lot. But yeah, it's prime plus whatever. For that kind of stuff. Car loans, same thing. It's short-term interest rates. So if you say short-term, you have to think of things that are 6 months, 1 year, 5 years, like in that range. That anything that's in that correlation is what you're going to see affected by the Fed's rate moves. Now, longer term things like mortgages, and like we would look at the 10-year treasury is a very, very good indicator of what's happening in the mortgage market. We use the 10-year treasury, even though they're 30-year fixed rate mortgages, but we use that as the kind of the barometer to pay attention to know whether or not mortgages are going to be moving, because the average life of a mortgage is going to be between 7 and 10 years. And it's a very similar instrument and similar investment and same kind of like yield that's being paid out to those that are investing in mortgages. So the 10 years is a really good indicator of kind of where rates are going, what's happening to mortgage rates. So that's more of a longer term piece, and that's where that money is flowing in. So you're going to see a lot of different factors that come in, and you're going to see money flowing into the longer term based on the Fed's actions, what they're doing short term to affect the longer term. So that's why there's all these dynamics. It doesn't always work exactly, correlated, where sometimes the Fed, increases rates and you'll see the long end drop. So you'll be like, wait a second, I thought mortgage rates were supposed to go up. The Fed just moved things up a quarter, but effectively the Fed is trying to slow down the economy. And if the Fed slows down the economy, the rates on the long end are going to come down lower because they expect a slowdown in our economy in the near future, or in the future. We'll call it the next 2 to 3 years. They expect a slowdown to occur based on the Fed's actions. So you'll see it start to affect the longer term interest rates based on what the Fed is doing today. So sometimes they'll have a adverse effect, or it would be an inverted effect on what occurs. So if Fed raises interest rates, sometimes rates go up, and because the Fed moves rates up, sometimes they'll come down based on what people project or what they think is going to be in the forecast in the future. So if you start to see indications of slowdown, you start to see indications of breaking of employment. If you start to see inflation start to lower, that's when you start to see long end rates start to come down, like we saw yesterday.
Okay, so these are all pretty serious sort of lagging indicators that we have, right? Like what the Fed actions today are going to affect us possibly 18 months down the road.
Oh yeah, and that's what they're trying to do, right? They're trying to figure out how to stabilize the monetary policy here, and also like keep inflation in check. They have inflation things that they're trying to achieve. They're trying to achieve 2% inflation. That's their goal. Clearly, that's been a miss, right?
Yeah.
And a lot of the actions haven't been able to do. Now they're affecting it, expecting immediate results, or the market might expect immediate results, but clearly that hasn't happened. They've made significant moves, some things that we haven't seen since the 80s or early 80s. They've made these significant changes, and we haven't seen the effects of it. Employment's still really good, and we're still seeing inflationary numbers that are coming out that aren't at what they expect. So, really, it's confidence. Does the Fed have control is affecting that longer term market? And yesterday was just an indication. It was just a tenth of a difference in a number, which is like a rounding error. But in terms of what like this looks like, and maybe it's the start of a reversal, that's where you start to see that money start to pour in, and you start to see these trades.
People are optimistic.
People are optimistic for bad reasons, but they feel as though things like the Fed does have this under control, and inflation is coming down. So we could potentially have an opportunity for having combating inflation for this amount of time, that we're not going to be in a spot. Inflation is going to have a bigger effect than any other data point to long-term rates. So like that's why people pay attention to it so much, because the Fed's goal is to keep it at that 2% rate, and it'll affect rates going forward and on the long end. So when you see these moves and things that like maybe things have reversed, they've been wrong for quite some time now, and they've been higher than expected for quite some time. And once it missed by a little bit, you saw all that money kind of pouring in, not wanting to be on the wrong end of this. I'm sure you guys have heard it on CNBC, this higher for longer was the trade for, 2 or 3 months.
Yeah.
And now it's like, oh my God, this might be it. They might have, effectively made the turn, and inflation's coming down. Let's get out of this trade. So more money just pours into buying bonds, which then pushes rates down.
Okay.
One thing to look at, Cory, just from like a everyday perspective, is like what Rob said, is they're trying to slow the economy down. But I don't know how often you travel, but airports are still filled. People are still going on vacation. You're still seeing people spend money, whether that money is being spent on credit because we have the highest consumer debt in history. That's the one thing I think that's been challenging from the Fed perspective, is housing is definitely slowed down, but is the rest of the economy, just looking at overall spending, travel, leisure, it has not slowed down at all. And it's
Yeah.
becoming more and more challenging for them to really stick to the plan and gauge if it's working or not. Because I think Jerome Powell said, what was it, 2 meetings ago, kind of, we haven't seen these rates in place long enough to see what the impact is on the economy.
Yeah,
I think the ease of credit is the big piece to that, Mike. And that's a great point that you have, where it's like it used to be where if you like pulled out your pockets, it didn't have it to buy it, you just didn't buy it. And now you have the swipe or put your phone up and you bought it. And these are larger ticket items that are just easier to get access to credit today. And consumer debt is at the highest levels that it's been in quite some time. So you're right, there's a little bit of a delay. And once credit starts to tighten up, which we're starting to see now based on where credit is, in general, you'll start to see that those slowdown indicators come in.
So, Mike, I want to ask you a question, because Rob, what you just so well explained was there are these like overarching macro factors that are coming into it that are affecting these interest rates. And then you got these little guys, you got Mike and I, we're like boots on the ground trying to get our buyers into homes, having conversations where the rate could be different in the morning by the end of the business day. And it makes for a very challenging landscape, and it makes for a lot of just challenging conversations. And so, Mike, what I want to ask you about is like, if I want to buy a home right now, what strategies, or how should I be thinking about when is the best time to lock in my interest rate? Or also, like, when I hear, so if I turn on the news and Rob's on the news and he says, oh, well, there was a difference in 0.25% between, 9 a.m. and 4 p.m. Like, what does that mean to me tangibly? How does that affect my buying power? What is a 0.25% in some instances doesn't sound like a lot. But, I know from experience that on your mortgage, 0.25% is significant. So just like, do you have any like kind of hard and fast rules or things that people can keep in the back of their mind when they see a headline like that?
Yeah. And Rob's been training our team very well. Basically anything inside of 75, 90 days, we lock, or we encourage folks to lock, to the point where one of our other leaders who put out an idea, if it's ultimately up to the consumer, we can advise them, but some people, they monitor this stuff probably more than we do. And like, I want to float. So we get it in writing. If you're going to float, we need it in writing, because if rates go in the wrong direction, we can't go backwards. In regards to like rates dropping, the movement happened on like Tuesday, I think. Yeah. And so a lot of us locked Monday. There's a little bit of movement, but it doesn't always filter through directly to the rate sheets. It's almost like, when the price of oil drops, you're not going to see the gas station prices drop instantly. So it does take a little bit of time. We do have the option to renegotiate rates if they drop far enough. And one of the biggest things is the security. I always tell my clients, we're going to lock in. This is your insurance policy. God forbid rates go up, you're good. If they drop, maybe you missed out on like $400 or $500 to your closing costs. If they drop enough, we'll look at redoing it. But the last thing you want to do, especially right now, because what I'm seeing more and more is not people aren't qualifying, it's their personal budget that they have to pay the most attention to. Like, folks can afford a $450,000 house by our lending guidelines, but when they see the payment, it doesn't factor into what their personal budget is. Because, from a lending perspective, we look at what shows up on a credit report, taxes, insurance. We use gross income. So that's, if you're a salaried W-2 individual, you make $75,000 a year, we use that as qualifying. But everybody in America knows that's not what you take home.
Sure.
So when you factor in the debt ratios we have to adhere to, and then people's actual budgets, because they have to factor in utilities, tuition if they send their kids to
medical bills,
public schools, medical bills,
right,
fuel, groceries. We could go on forever. So that's where you have to be more of an advisor to folks and say, here's what you can afford, but what can you afford? And that's actually having a lot of people sit out right now because they want to wait and see. To answer your question about like a quarter in rate movement, so if you use like a $400,000 sales price and 5% down, so a $380,000 loan, I did the math before we got on, it's $115 a month difference.
That's
That adds
significant.
up over time, but
100%.
it's not making or breaking people's budgets. I mean, at the end of the day, that's like a cell phone bill, but it does make a difference. So that's the thing that we're looking at. And you would know better than either one of us, Cory, is when is there a good time to buy? It's what works for that individual family. Because especially in the triangle market, we have every day, it seems like we get news of another company striking a deal to add jobs here or a company moving here. I mean, just in Greensboro, Toyota's putting that battery plant in. That's going to spill over towards Durham. There's people moving here. So the point being is values are going to go up. We're going to see that normal appreciation in values. We're not going to see the crazy COVID appreciation like we did in the North Carolina market, where some years it was 15%. But then you have to factor in, all right, if it's $115 for a quarter in rate, and this is a much more deeper dive, let's look at what a point does. But if you're saving a point on the rate, but wait to buy that house next year, and the sales price increased by 6%, what did you really save?
Right.
Never promise a refi, but we should be at the top end of a rate cycle right now. So there should be an opportunity to potentially save money down the road, and you got in on that particular property at a much better value.
So, okay, a question to kind of piggyback off that point, and it'll be for both Mike and Rob. You can weigh in as well. There has been a term that I see a lot of real estate agents throw around, and I don't know if I personally am incredibly fond of it. You see this a lot, especially when interest rates started on their sort of upward trajectory like 8-10 months ago. Marry the house, date the rate. And if you have not heard marry the house, date the rate, the idea is, just do whatever you can to buy a house now because you can always refinance later. And this higher interest rate environment that we're in right now is fleeting, and in a year things will come back down and you can just refinance. But there is so much wrapped up. It's not like you just refinance and everything's hunky-dory. There's costs associated with it. There's a lot of uncertainty in where rates are going to go. If you're only, Rob, you said earlier the average life cycle for a mortgage is 7 to 10 years. I feel like a lot of the people that I work with are moving after 5, sometimes even less. I mean, there's so much mobility in this generation of homeowners. People are taking jobs in other places. They're in and out of houses every 3 or 4 years. So if you heard somebody say, marry the house, date the rate, it's not that simple. Well, what would you say about that? About this idea that, you can just refinance in a year?
Yeah, I think when people get too comfortable with forecasting, like I stare at it every single day and look at it and read everything I possibly can read and look at all the economic numbers, look at everything we possibly can, and I'm wrong all the time.
Yeah.
So
and you're our best guess.
Exactly right. And I have more knowledge than most and of how it works. And really it's a weatherman scenario. And I don't like the phrase just because we're just not knowledgeable in it. We need to make sure people are comfortable. This isn't a jam them into a home, feel uncomfortable with the payment, and because it's going to be better next year.
Yeah.
It's that we just don't know that. Now I do like, opportunities to buy down interest rates. If there's a temporary buy down opportunity, there's these programs that Mike and his team offer that do help a lot in terms of refactoring their mindset for budgeting. Some people need a little bit of time, so maybe using a feature like a temporary buy down where an interest rate can be lower for, let's just say, the first year or the first 2 years, there's a graduated amount. It does help quite a bit because they have time now to figure out what their budget's going to be. And if there is a refinance opportunity, they could take advantage of it. But we're not getting into the house being over their head in terms of a budget perspective and then saying, well, let's just use hope as the strategy here. We don't want to use hope. We want to put them into a really good financial position. And that's where these programs that Mike and his team offers really benefit the borrower in making a decision on purchasing a home now and rebudgeting themselves for the future. And then if rates come down, great, you have it. But here, at least they have that ramp or that leeway to be able to figure out what their budget looks like. And that might be a year or 2 years for that temporary buy down.
I look at those temporary buy down products in the way, and correct me if I shouldn't be thinking of it this way, but I think of it as a way of like hedging your bet a little bit, where
Yeah.
Rob, like maybe it's a household where one of the individuals isn't working this year for whatever reason, but they're gonna start, they're gonna go back to their job in 6 months or a year or whatever. So if you have that lower monthly payment for that first year or maybe that second year, like you said, but they can see the trajectory of their budget changing, then if interest rates stay the same or go up in the next year or two, they're locked in, they're good to go. And if they go down, a refinance might make sense.
Exactly. And the money isn't gone. It's not spent. It's available for them. And if they refinance, it comes right off their principal balance. So it's a good fact. Now you do need some seller contribution sometimes, and you need some things to be, creative in the contract process. That's why it's really important to kind of work hand in hand with the referral partners and like everybody be on the same page, and listing agents as well. Cause there's a lot of opportunities to like, hey, by the way, the house is more attractive if you can offer, potentially a 1% lower interest rate or 2% lower interest rate with a concession. So it's something that, the team does a really good job of and explaining to borrowers as well. But you have it spot on of your take on it, Cory, and it really helps people factor in the numbers today and then have a plan to budget in the future. That's what we want to do. We really want to make sure that they're in a really good position going forward and not, surprised by a much higher payment or stuck with a payment immediately. Because it's really hard to get out of that. Because you move into a house, maybe you want to do certain things. Maybe you want to change the kitchen. Maybe you want to repaint. You want to do these other items that happen when anybody moves into a house. Because everyone says like, oh, we're going to wait. I said I was going to wait when I bought my house. And then like after like 3 weeks of being in the house, my wife telling me over and over again that we have to change something. Guess what I did? I changed it, right? We made the changes. So it's a really good tool, and something that, like I said, when it all works out, right, and everybody's aligned with it, it's a great tool to be able to help kind of combat the higher interest rate environment.
Yeah,
Mike, marry the house, date the rate. What do you think?
I don't know if my social media that might have got snuck in there one time. I'm not a big fan of it, but I am a proponent of the temporary buy downs. But the biggest thing that I do is, regardless of who they're working with, consumers need to be educated on that, because there's a lot of misconception and misinformation on it. Like, on one end of the perspective, people think it's like one of these 228 arms from 2006 where we're utilizing the lowest payment possible to qualify these folks. And then when the rate adjusts, they can't afford it. It's the opposite of that, where they have to qualify off the fully amortized rate. And it's just a temporary fix. It's like a Band-Aid. But I always almost require a phone call when anybody starts wanting to ask about that, so I can go one-on-one with them question-wise, like, this is a solution, here's your payment, but you got to be ready for this full payment going forward if stuff doesn't change. So that's the biggest thing, is understanding, like, this looks great now, but if nothing changes in the future, then this is what you're going to be paying. Just want to make sure you understand that. And kind of to piggyback on what you were saying, like, I'm a weird outlier. My son is 9, the oldest. The house that we live in now is his 4th house. So people do move a lot. We're staying put for a while. But Rob would probably be able to speak a little more intelligently than me, is the problem with rates right now and getting them without a bunch of buy down points and everything is, this is a long-term hedge for investors. Long-term performance on mortgages is how investors don't lose money. So if the forecast is right and rates drop, these loans are going to go away in 24 months. So that's why you're seeing lending become a little more expensive. They're not going to offer lender credits to take a higher rate and, here, take this credit to take an 8% rate today, knowing that it's going to go away in likely 18 to 24 months. So that's the other thing that you have to look at.
Oh, and Mike, I just want to ask one question, just to clarify, so we don't miss this point, because I think it's really important. If I'm hearing you correctly, what you're saying is that the way a bank, the way a lender makes money off of a loan is the interest rate that's paid, right? So what you're saying is, if somebody takes a mortgage at 8%, the bank knows that borrower is not going to keep that mortgage forever, because we can all reasonably anticipate that at some point interest rates will be lower than that. So what they're saying with what you're saying with that they may not be offering lender credits like they were is because they know that no one's going to carry this mortgage, and they're not making money if people don't carry the mortgage.
Correct. And
Is that
I'll
right?
let Rob chime in on that because
Yeah.
dealt with
I'm
the
chomping at the
second-
bit at this one, but I love to hear this and great topic or question. I'll be quick with it. It's just simply that 80+% of the loans that are originated in the United States end up in the securitization market. So it's not like
That's
a simple
the secondary loan market.
Yeah. So like a loan ends up in a security that becomes a tradable commodity that people then, Wall Street takes in and people invest in. You might have some, Iowa pension fund is buying mortgage-backed securities for a 3% return or whatever it might be, a 5% return. So that occurs in the market. So people always think like, oh, there's a mortgage, goes to a bank, and the bank sits there and the teller is collecting a payment from a borrower and I keep that interest. That's just not how it works. If that was the case, the U.S. mortgage market would have stopped a long time ago because there isn't enough money to go around. So with housing and what it's doing here and how we have it and being a $12 trillion market in general, there has to be a securitization or a vehicle for people to invest in mortgages. So just know that people, and when it goes into a security, someone pays you for that potential cash flow in the future. That's what Mike's talking about. So if it's a security and let's just say there's a $100,000 loan, someone may pay you $2,000 for that they'll pay you $102,000 for that $100,000 loan in the hopes to collect interest over time. And that's what they'll pay you today. And that's how the mortgage market works. And that's how you price. And at a higher rate, maybe the more premium there is. But people just don't want to pay more premium if they think if you're going to refund. Like, why would I pay 5%? Why would I pay $105,000 for a loan today that if you paid it off tomorrow, I just get 100,000. That sounds like a bad deal. I'd lose $5,000, right? Yeah. So that's how that market works. So it's the hopes and the modeling of future cash flows is how mortgages are priced and how the securitization market works. So when rates move like they have and they're at its elevated level and people are forecasting rates to come down, you end up having a scenario where people are like, I'm not going to pay a lot for that loan now because I think it's only going to last a year. Yes. And when that happens, that's when things get a little bit more expensive, like Mike mentioned, where the cost of borrowing, and you've seen it where like we had a stretch, our company had opportunities to get to rates without points, but a lot of other companies didn't have the opportunity to get to a rate without points. People were just, our best rate is, 7.5% with 2 points. And that's the best we can offer. And it can't go any higher.
Okay. So I'm really glad that we kind of segued into this topic because Rob, I think what you were talking about before when they have these movements in interest rate and you said money's flowing in or money's flowing out, that's what you mean, right? Money's flowing into these securities or out of these securities. So when things are and that's what you meant earlier when you said opportunity, but not in a good way, because what you were saying was when we're predicting interest rates to go up on the rise, money flows in to this. People are buying up securities, right? Because those securities are going to get better for the investor. Is that what that's what you meant, right?
It's all about investor appetite and what they're comparing it to. So if it's most of them, like it's near 80% of all loans are written to not only to a security, but the fact that they're backed by the U.S. government.
Yeah.
So they have some semblance of insurance, guarantee, whatever you want to call it. There's all different agencies that insure it, but at the end of the day, taxpayer dollars are backing the securities themselves. When you look at that market and you compare it to U.S. debt, which is also the backing of the U.S. government, people look at it and go, well, do I want a 10-year treasury at 5% or do I want to pick up some mortgages at 6.5%? I like the mortgage play, and they'll invest in that. And that's the money that's pouring in is people investing in these MBS, in the mortgage-backed securities themselves as an investment instrument. And that's where the money comes from. And it's a lot of institutional money. It's a lot of that, but a lot of people have it in their portfolio and they don't even know it. It just could be in your retirement account.
So would you say historically a safe investment?
Yeah, it's been pretty darn good, except for one time. I don't know if you remember. Back in 2008,
right. But my understanding is that, when you have a long-term safe, a very safe investment, that's when you get your pension funds investing and you get your insurance companies investing, the institutional investors, because they like that constant return, relatively safe, securitized, right?
Correct. And the difference between the two markets of pre-crisis and post-housing crisis is the fact of like the type of loan that's originated and type of security that has been created. Like post-crisis, there's never been a better cohort of loans ever
Right.
originated in the history of U.S. mortgages ever. So
Yeah.
it's been the highest credit scores, the lowest, the highest down payments, the best debt to income ratios. It's the highest quality we've ever had. Pre-crisis, that wasn't the case, and it was only 30 to 40% of the loans were insured by the government back then, and now, like I said, 80 plus. It used to be 90+%, but now it's 80+% of the loans are backed by the government anyway. So yes, the investors, any of the government-backed loans and securities all have made out very well, and anybody who invested in those in terms of achieving their cash flow desires that they thought they were going to get. So that has been a very good investment and safe investment for the pension funds, insurance companies, and whoever else is investing in it.
Yeah,
So-
Cory, and the GSEs are Fannie, Freddie, and then you have Ginnie
What
Mae.
is GSE?
Government-sponsored entities, the government-backed loans. That's Fannie and Freddie for what people most likely hear.
Okay. Yeah. So, I mean, I could talk about this all day because I find it fascinating. And I also think there's a pretty big disconnect between the general public who, your average home buyer who's, hey, I'm just trying to buy my first house, or, we're just trying to buy our second house. Like what I was saying earlier is like Mike and I are we're the boots on the ground, like dealing with the fallout of these macro, decisions that are made, way up here at the top. And there's definitely a disconnect, I feel like, between your average home buyer just trying to get their mortgage and what's happening on the secondary mortgage market. And even so, I've been doing real estate full time now since 2018. My understanding of what happens after somebody closes on their loan and where it goes is limited. And I talk about and learn about and read about this stuff more than the average person. So I would love to do another call sometime where we really dive deep into the secondary mortgage market. Because again, I think if more people had an understanding of what's happening sort of in the background, they would be better educated when they go and shop for a mortgage and when they see a headline. Because I think there's a disconnect.
Cory, there's a huge disconnect. Now I'll have one point that I do want to mention for today, because I think it's important about the decision to buy a house or not, or the potential crash because housing prices have gone up. And, where, nerds like me get to kind of go in, if I'm at a cocktail party or if I'm out, like people always ask, what's going on with the market? Like, when's the crash coming? And
is anybody here an economist?
Yeah, exactly. But you look at data. And if you look at data and you look at demographics as one side of it, and then if you look at like what I care about, which is like what is required in a crash, what happens in 2008, what happened in any kind of depression of values, is delinquency data. Like you need to have more inventory than what demand is, and you need to have loans going bad because people just aren't paying, right? They're just not paying, and that's going to be more supply coming in. And that's just not like the data is like, we're not seeing even the beginning stages of cracks in the foundation for any of that. Now you're seeing consumer debt go up a little bit in terms of housing, and because where equity levels are and where rates are, the delinquency data is incredible. Even slices of loans that you would think would normally have a higher delinquency rate, they just don't exist. And without delinquencies, without foreclosures, it's very difficult for crash-like scenarios where people are waiting. So that's the discussion point I have when people are like, I'm on the fence. I'm like, well, you're on the fence for what?
Yeah.
Like, what are we waiting for? If CNBC pops a headline about, lower home prices, and they talk about lower stuff, but most of the time the headline is to catch your attention, and you look at it, it's like, it's lower growth. So it just the slowdown is that it's going higher slower is what the headlines to make you think like it's bad. So if you're going to be buying a house, then like if you see yourself in a home in the next 3 to 5 years, then you should be buying now.
Yeah.
Like that's what we put in until we start seeing data that otherwise shows differently. Like and you keep going through it, and I've been saying it, and there's been housing crash people on the media nonstop for the last 3 years.
Yeah.
And all I do is point to the delinquency data.
Right.
Look at that. And when you start to see this increase a significant amount, we're still pre-pandemic levels.
Yeah.
Like until you see that, like you should be buying. Like that's my take on it.
Yeah, there's always going to be foreclosures. I mean, but they are the lowest ever, because one of the other things is people have the most equity that they've had in their property in a long time. So if they do get into a tight spot, they can sell it. But most of these people, like Rob said, are not getting into tight spots. And even if they do sell it, it's going to still be at fair market value, and it's not going to increase inventory a bunch. And this can be a call down the road. But the other thing with the inventory piece is we created the most landlords in history over the past few years. I saw an article on that, I think it was in Housing Wire, because so many people that took advantage of the 2% and 3% rate mortgages, they cash flow so well. They have so much equity. They're keeping it and renting it because, as you know, Cory, especially in our area, rental inventory is down too. The rental inventory that's there is ridiculously expensive.
Yeah.
Like I'm seeing some 2-bedroom apartments in Raleigh that are not like brand new in downtown. They're in like a suburb, or like $2,000 a month.
$2,000. Yep.
So if you have somebody that owns a $300,000 house and their mortgage payment from these low rates is $1,800 all in, they're going to rent it to that family for $2,500. Why would you go rent a 2-bedroom apartment where if you're trying to figure out if you're new to the area or don't want to buy yet? Why not rent a single family house with a yard for $2,500? And that's going to continue to contribute to the inventory piece, which is going to keep values.
No, they're not going to want to sell. Why would you sell? I mean, I took advantage.
Yeah.
Right. You know, you helped me with my loan for our first house, and we bought a second house, and we kept the first one as a rental. But we were at a 3.25% interest rate. So I don't ever want to sell that out. But Rob, I do want to touch on one thing before we go into my last question, which is, I mean, it seems like what you said before about post-crash underwriting, the rules changed dramatically after 2008, 2009 as to who could qualify for a loan. So you have more, and maybe I'm off track here, but it seems like you have more qualified individuals who have taken on these mortgages. So the point seems like to me was to have less foreclosures. Like that's why everybody tightened up their guidelines, their underwriting guidelines. So it seems like now, we're just seeing that effect of more qualified people holding on to these mortgages. So there's going to be less foreclosures. So naturally there's going to be lower inventory. Whereas pre-2008, like you said, you could kind of track inventory based on those foreclosure rates. Is that right? I mean, we're in a situation, but it's by design.
Yeah, the rules were put in place, and I would say probably there's some dynamics to that weren't intended, right?
Sure.
The unintended consequences of what's happening in regulation. With a lot of times, you may get frustrated with a borrower who has money, maybe not income, but has money. They're always the toughest, in terms of different rules and regs that have come in place. But in general, the like I said, this, if you look at the I just call it credit quality. If you look at credit quality, it's off the charts of where it used to be. Like it used to be a year of breathing. You can have a couple bucks, you can buy a house. Then it was like you didn't need a couple bucks. You actually could skip a couple breaths and you can get a loan. That's what happened pre-crisis.
You could get some money back.
Yeah, exactly. Get some cash back. It was a cash flow positive transaction. That part that went away, rightfully so. But in terms of like say, I use the word cohort of loans. Now it's like 10, 12 years of that cohort has been the best quality ever, with the best backing ever. So it's like I said, it's difficult even in any semblance or form to envision the fact that they're government-backed loans now too versus private securities, which is what happened in a crisis. It's very hard to imagine a situation where you see a fire sale of all the foreclosures in some bulk, wholesale reduction of value or something like that's just. It's just not in the cards, That's what we kind of try and project out to everybody. And the people that did buy homes are in a position because of the high quality to do the things that you did, right? Which is keep that next house and use it as and think about the investment piece. And, you always go back to the net worth of homeowners versus net worth of renters. I go back to that all the time when someone asks me about buying, and I say, look at the situation right now. If you ever asked, it was always better to buy yesterday.
Yeah.
But you don't have a time machine, so you can only live in the present. You want to buy now, and that's the question I get asked, and my answer's been very consistent. And I'll, both sides of the coin, I'll look at it and say if I see delinquencies and I see that housing has an opportunity for that, we'll guide them to saying this is a longer term investment. We're just not seeing that right now.
Yep. And Mike, I know you and I have talked about this with some of our clients. I see a lot of real estate agents, a lot of realtors, a lot of people in the real estate space just totally lambasting renting. You should never rent. You're throwing money away. Like, what a waste. And like, I'm of the mind of like, look, you're not throwing money away. You're getting a safe place to rest your head, and a warm bed. Like there's some tangible value there. However, when I talk to my clients, it's like, look, if you can make purchasing make sense with your budget and your goals, then it's and you're planning on staying there for a few years or staying in the house for a few years. If these factors make sense and you can swing it, it's going to be a better option. But if it doesn't make sense, like stretching your budget out just to make it happen could have, an adverse effect. So it's like, it's got to make sense for you.
It's individuals, or it's going to be individual if it makes it work. Like if you're moving to Raleigh for a temporary contract position and you're going to be gone inside 2 years, it probably doesn't make sense to buy, especially with our limited inventory. There's some people that unfortunately can't buy, and that's what the ability to repay rules that Rob were talking about that we put in after the crisis that prevent folks from them buying, because it's going to lead to a future foreclosure. So there's always going to be a rental market. Unfortunately, some people do not have the fiscal responsibility to be a homeowner. And then the biggest thing with new homeowners is always education, because you have to make sure that you're willing to take on that responsibility. It's not a daunting responsibility, but
can be for some folks.
Renting to your whole life to purchasing a home, you can't call the landlord when the HVAC goes out. You can't just, I don't want to live here anymore, just I'm not renewing my lease, pack up and sell. There's cost to sell. So it comes down to just educating the pros and cons. I'm an investor myself. I have 5 investment properties. I see the benefit of home ownership because it does increase the net worth to families. That's going to hopefully be my retirement income, maybe something I can leave to my children one day. But we didn't just dive into it as like, we're going to start buying investment properties. We're going to start moving. When we bought our first house in 2011, I was not in this industry. We did a ton of research to make sure that going from our little 1-bedroom apartment to a townhome was going to make sense. So there's going to be arguments for both sides. Some people are happy renting. They just want to stroke a check each month, not have to worry about anything. Some people want to be able to do what they want on their property. They want to build an outbuilding so that they can have a workshop. So we can go on for days about that, but it's always going to be individual scenarios.
It's relationship versus the transaction, right? Like that's the key component here, Mike. And that's why you use like good people, right? That's the key. Like Mike is a very good human. That's who you want to work with when you're talking about this stuff, because it's very easy to get a commission, do the deal, transaction, and they weren't ready.
Yeah.
Now Cory doesn't get that next opportunity. Now Mike doesn't get that next opportunity, but if we just prep them, educated them, and maybe in 6 months they're ready, or a year they're ready, now you're talking about somebody who comes back for that next property that they moved up in that next transaction, versus thinking of it as a bad experience. And really that relationship versus the one transaction makes a big difference. And that's how Mike operates.
100%. So I want to be sensitive to both of your guys' time, because I could literally talk to you all day. But I just want to ask the last question. Rob, I'm sure you're just getting this everywhere you go, when you're at a cocktail party, or when you're, anytime you meet up with a friend and they say, how's the market? How are interest rates? Where are they going? And what do you think? I'll preface by saying that nobody on this call has a crystal ball. And we've already established that the best we can do is make an educated guess on where we see interest rates going. But, just give us your 2 cents on what you're seeing and what the data is telling you, and what we might be able to expect in the next 12, 18 months.
Yeah, I probably shouldn't have said like cocktail party. I'm envisioning everybody thinking this is like me in a tuxedo on a Friday night, with a martini or something. No, but I just go to my friend's house and we have a beer. But yeah, so that part of it, listen, I look at the data, I look at the forecast and what it's looking like. And right now, where this curve and where this looks like it's going and what people are forecasting for the market is showing the short-term interest rates will be coming down during 2024. So they have the Fed rates coming down, and it looks like it might be down, 1 full percent, by the end of 2024. And if that's the case, and if things are trending the way they are right now, if this was a turn in inflation, I'm hedging my bet by saying if this was a turn today going forward, we could see a solid 100 to 150 basis points, so 1 to 1.5% move in mortgage interest rates. Are 3s and 2.5s coming back? Prep yourself. No. No. The answer is no.
Sure.
But we do see things coming back to more normal mortgage market, which a normal mortgage market is healthy. There's buying and selling. There's premium to be had, so mortgage companies can offer a rate and be at par for our borrowers. They don't have to have like a lot of cash coming to closing. So those things are we do forecast that coming in. And do I see rates in the mid 5s, lower 5s by the end of the year? Potentially, yeah. That there's an opportunity for that to happen for sure. But it's this key moment right now is this inflationary turn. We're going to be paying attention to inflation numbers and employment data, and that's what we need to see. Employment weakening a little bit, which is not great, for certain people, but in general for the economy, it is a good thing. It's really tight supply right now. And then looking at the inflation numbers. If inflation does come down, we could see a rapid move in the second half of 2024. So that's kind of our forecast and what we're looking at, and thinking it's going to be more normalized numbers of what we're used to pre-Fed intervention and buying of securities causing rates to come down. So seeing that 5 to 6.5 range is a stable mortgage market.
Great news. Yeah. Potentially. What was I going to ask you? I forget. You said maybe come down a point and a half. I don't remember exactly what I was going to ask you, but that was a great point. And I was just going to say, when we talk about economics, there are also some broader, there are some unknown factors. Oh, I remember what I was going to ask you. How often does that the CPI come out, and do we track inflation? Is that a quarterly report? Is that a monthly report?
It's a monthly report. Yeah, it's a monthly report. And for us, like we said, we track it. There's indicators and obviously what they anticipate it's going to be, what the forecast says, and then the actual numbers. So it's never about what the number is. It's about what the forecast was, because the market already intended a certain number to come out. And that's why it comes out. So some people might see like, well, it came out, the headline number was, 4%. That's higher than what the Fed wants. Like, no, we were forecasting 4.1 and it came in at 4. So it came in under what the forecast was. Therefore, we see this move in interest rates. So that's what we're looking for, is if it's going to be a little bit lower than what the forecast says, that's going to be very good for mortgage rates going forward.
Okay. That is super helpful, guys. Like I said, I could talk to you both about this all day, and I want to be respectful of your time. But this has been a really helpful conversation, not only for me, but I think the other people who will watch it, just to get a better understanding of how all these pieces fit together. Because, Mike, I know you're having conversations with home buyers every day. I'm having conversations with home buyers every day. And we live in such a sensationalized headline environment right now that people I feel like there's so much misinformation around what could happen, what's going to happen, what happened yesterday, what's happening tomorrow, that you can't make an educated decision, or it's very difficult to make an educated decision. So I think just taking it, a step or two deeper and getting a better understanding of how these decisions impact the average person who wants to buy a house is just super important. And I really appreciate you guys spending your morning with me and helping shed some light on it. And I hope we can do this again.
Yeah, absolutely. You've already promised us to do it again, so I'm going to put that on the calendar. I want to rant about mortgage-backed securities for a while. No,
no, seriously. That's the like next level conversation here, right? Is just like what happens next to your mortgage, right?
Complexity behind the scenes. Asking what rates are going to do and how the mortgage market works is like somebody that just moved to the area and saying, "Hey, Cory, how much does a home in Durham, North Carolina cost?"
Yeah, right.
What?
Yeah, it's like a drop in the bucket.
Yeah, and I think for you and for anybody that's watching or anything that we see here is that just know that like headlines, CNBC and everything else, when they come out with mortgage rate data, it's lagging.
Yeah.
It's a week behind when they put anything out. A lot of times we have to like roll back or tell them it's even better, depending on what's happened. It's always like you're looking at last week's data. headlines today. So always know that that data is a little bit, delayed, and talking directly to someone like Mike is a better scenario to find out where things are, and keeping your eye on that 10-year treasury if you want a quick indicator of kind of where mortgage rates are going.
Yeah, very cool. Well, Mike, Rob, again, really appreciate it. This has been great. I would love to do it again sometime. We'll get something on the calendar. You guys have a great rest of your day. I'm going to stop the recording now. But I'm sure you guys got to roll. Thanks, guys.
All right. Good deal.